If you look at all the global strategies talking, they're underweighting the Australian market for bonds. Why? Because interest rates are starting to rise. And since it's at historical low, that's a long way to go. You know, interest rates can move up for 2 years. So I'd just like to pose this question to Julian.
Thanks, David. Very challenging indeed. Let me just answer the first question, or rather come to defense of the first question, not because it's my bread and butter. Okay, the first one, David was mentioning about the Blue Law of Layman did highlight a risk associated with structured products. Yes, indeed. But let me say that credit is very important. Okay, if you happen to buy a Lehman-issued structured deposit, then that's it. The investment blew up because Lehman went to bankruptcy, right? So credit is very important. Of course, if you buy a credit-linked note or a structured deposit issued by one bank and that bank collapses, then your risk is with the bank. So the key is invest with a bank that is deemed safe. Invest in a bank that operates in a jurisdiction that is very well regulated by the central bank, right? And the other point is to note is also, if any of these structured products don't do well in terms of investment return, it's because the investment view fails to materialize. Okay? If a structured product is linked to commodities and expires in Q4 last year, too bad, commodities fell. But if the same product expires today, commodities would have gone up 30%, right? So it's as good as buying a stock. If you buy a stock and it falls, too bad, the investment view didn't materialize, right? So the key here to investment in structured products are twofold. One is credit and the other one is investment view. Same as investing in any other instruments. Now, David's second question on a very challenging environment that we are facing now. Global bond yields are very low. At the same time, you are seeing tightening modes. Indeed, over the next few years, in fact, things can be very inflationary because of the extent of stimulus being pumped in, both in fiscal side as well as the monetary aspect. Now, the good thing is that there are ways in the fixed income market that we can go around it. First of all, if we think that there are interest rate hikes to come, we as bond fund managers will go short on duration, means we buy very short 10-year bonds. Okay? So these bonds may mature at the point when interest rates are hiked, so we can go in and reinvest at higher rates. That's one point. The other point is that the market in fixed income has developed over the past 20 years with a variety of instruments. Now we are having, on my side, I look at the global front as well, the Asian fixed income market. Now, over the past 10 years or even five years or so, led by the US and developed nations, there are all these bonds linked to inflation and bonds even linked to GDP. Now, what it means is that these bonds which are linked to inflation, when inflation goes up, it's good. It means the coupon payment goes higher. It means the price goes up as well. Korea has these kind of bonds. Brazil has these kind of bonds. I hope Malaysia will have as well. So, in other words, fixed income market and instruments do provide a means of diversification. Even if Malaysia doesn't have these kind of instruments, fine and well, through structured products, I can structure something like an inverse range accrual, where if interest rates go higher, the returns, the payment from the coupons will be higher as well. See? So this is the beauty of derivatives in a fixed income market, where you can cater your returns to different strategies, to different market outlooks and different asset classes. But the key is the returns commensurate with your views. If your views are correct, you make money. And of course, the opposite is true. Likewise for any other asset classes, equities, commodities, and so on. Thank you, David.
Thank you for that, Julian. But you didn't really answer the question on which will win out in the end. You think the bond market or the equity market?
Sure. Okay, the thing is that I have to admit, I'm humble pie to admit that I don't have a crystal ball, in the sense that I wouldn't know when is a tipping point of which the recovery turns into an inflationary and reflationary kind of environment. At this point, what we are seeing is there is very little growth. There is very inconclusive evidence of a recovery that's sustainable. What we are seeing now is that we are in a phase that we are mending ourselves. Remember the chart that I showed you earlier? We are in a phase where we are on the mend and the phase where we are in a recovery, right? So in this kind of scenario, we will see bonds continue to be positive, to outperform, alongside with equities. Okay? Now, the key is that when inflation does happen, if you look back at history, if history is a good guide, in 1980, when inflation in the US soared up to above 10%, the Fed Reserve hiked Fed funds rate to 15%. That was 1980. The preceding years, S&P 500 fell by 30%. So if you take that scenario and plow it into the scenario going forward, you will see equities coming down as well. Bond market, yes, yields will go up. But I would suspect that when that kind of bleak scenario happens, when say S&P falls by 30% in a very inflationary environment, then there will be flight to safety back into some sort of very short-term fixed income. Not those 10 years. Of course, I can tell you that fixed income, say US Treasuries 10 years, will fly up the roof to 6% or even more when that happens. But the key is that you don't have to go to 10 years. You can go into either Treasury inflation-protecting instruments or even the very short-term 2 years, and that will give you the extra returns when interest rates are bumped up.
Thank you for that response from a fund manager's perspective. But say for the benefit of our audience today, should they underweight their bond funds for the next year, or they are okay because interest rates are going to be just low because this recovery is going to be pretty muted?
Sure. Very good question. Okay, so my answer is select carefully on the strategy. Okay, they are
He's from Arab, by the way.
I'm investment management. Now, okay. Now, fixed income funds. We have got emerging market bond funds. We have global bond funds. We have the Malaysian bond funds. Even Malaysian bond funds, there are a few. One is an income, money market income fund, and the other one is what we call as M bond, and the Islamic version of M bond Islam. Now, the key is that look at the fund fact sheet. This doesn't only apply for our own funds. Even if you invest in funds that are offered by other fund management houses, look at the fund fact sheet. The key is look at the strategy. Okay? If the strategy is very bullish, that means fund managers are going to invest all the way to the long end, 7 years, 10 years. Be careful. Okay? If you have the fear of inflation lingering in your mind, and these fund managers are taking extra risk by going on the long end of the curve, don't invest. Okay? But if those fund managers in their strategy sheet clearly mention that they acknowledge such risks, they're going on the neutral or the shorter end, then these are the funds that I think will be safe. Okay? Don't forget, fixed income funds are a bit different from equity funds in the sense that every day there is accrual of income. Okay? Every day coupon is being accreted, coupon is being paid, so the NAV will go all the way up. But of course, price also matters. Price will result in whether the fund tumbles or will go up further. The key is always read the strategy outlook. And I guess investors are getting more sophisticated. Otherwise, you all won't be here today, right? Grill the fund managers if you like on their views. Grill them on their economic outlook. Okay? So it is very important. If the economic outlook departs a lot from the general consensus, then grill them further. Ask them what crystal ball are they seeing. Are they taking a lot of risk just to outperform the rest? I mean, they always say hero die last. Okay, so try to avoid these kind of heroes.
Thank you. Thank you very much, Julian, for that. I'd like to move on and talk really a little bit about the US dollar. I pose this question to Lorraine again. Is the US dollar toast? Meaning that it can only go one way. Everybody talks about their phenomenal deficits. Although the current account is turning, can it only head one way? And the related question really is, so what actually is the implication for the various asset classes, whether it's equities, commodities, fixed income? Thank you.
Okay, on the US dollar, because, I mean, we take a short-term, if we look at a short-term basis, I think there is probably expectation or for the dollar to continue to fall in the near term. And the reason because there is a yield gap now, especially because we don't expect the U.S. to raise rates before anybody else does. So I think there is going to be movement towards where there is interest income, and that's going to keep the U.S. dollar relatively weak. But but where it goes, I think we may go back to where it was in the middle of last year, but we really don't expect it to collapse. And the main reason for that is that there's no alternative. As much as we like it or not, there's no other currency there that can take the place of the US dollar for quite some time.